Awesome, guys. Well, welcome back. This is to our recorded session. We did try and record the previous live session, but for those of you who were on the day, it was a little bit of a disaster. Fortunately, not due to us, but due to Microsoft being down. So here goes a second shot at the recording, and trust you will get some benefit from this. Yeah, so today we just want to go through a bit of a reflection back on 2022. I think it's important to do. Many of us want to forget 2022 for sure. It was an exceptionally volatile and not a fantastic year at all on the markets, but we need to look back. And then a little bit of an outlook for 2023. I'll go through that. And then Tawanda's going to take us through just a bit of an introduction. Not the full details, but just an introduction into the new seed shortlist. And then we will also just have a quick one-pager on some of the latest Reg 28 amendments. So without further ado, let's look at 2022, just a bit of a reflection. As we all know, it was an exceptionally tough year across the globe. And if we look at the dominant theme for the year, and that was wealth destruction. Global markets shrank back massively. I mean, these are big numbers, 15 trillion, and I've seen this number about 30 trillion across global markets, including bonds. And really, except for the US dollar, all other asset classes fell pretty sharply. Yeah, we did have a little bit of a uptick in the local market, but really nothing ahead of inflation. So when we take inflation into account, all assets really fell sharply. The big wealth destruction came across a lot of the tech shares, and obviously most investors have some exposure there to these names, having built them up over the previous years. Facebook, Tesla, Google, Amazon, these are just some of the names, obviously the big names that really came down dramatically in the year from peaks. I think the big thing is the fourth point there, is that your typical global diversified strategy of a 60% equity and a 40% bond portfolio really didn't work. We continue to preach diversification. I think you do as well to all your clients. It works generally, but not always in certain instances. And last year was definitely a case where it did not work. 60% equity, 40% bonds fell down a massive 17% in dollar terms, almost its worst year in almost a century. So those are the big themes. If we take a look at just the numbers there, I've put this up because I mean it is instructive to look not only in the 2022 but the run up 2019 all the way through. And yes, we have had some very volatile years. Started off really 2020 when we obviously 3 years back now we had the COVID crisis kicking off. Central banks, markets took a knock, and then central banks really opened up the taps, and that really catapulted risk assets over the next couple of years, 2020 and 21. And was really the forerunner, the catalyst, so to speak, of the decline that we had in 2022. If we look at what fell the most in 2022, it really was some of those asset classes and risk assets that moved up the most. The NASDAQ 100 is typically more populated with tech shares, and you can see we had a huge run up there. I mean, that's in dollar terms, 39%, 48%, 27%, and then a big 1/3 decline. And then again, I've put Bitcoin up there as your classical additional risk layer, so to speak, and you can see the run up it had 94, 358%, and then down a huge 64%. Some individual names on the tech space were down very similar percentages and even more. So a huge wealth destruction. Gold was muted. It didn't have a big run up, a huge run up, and which surprised many, but then it didn't have a massive decline in 2022, only up, just up, effectively flat for the year. So those are the numbers. If we take a look at some of the detail, and I won't go through each of that. And you can use the slide for your own purposes, but the end of 21 ended on a high note. In November, December, markets were making absolute highs. The bond market made super low levels in yield terms, which is effectively a high in price terms. And then inflation was starting to pick up, but it wasn't a major concern. The word transitory was bandied about a lot. Then we had obviously the Russian invasion into Ukraine, and that set off a lot of global supply chain problems, not least of which was the oil. The Fed started raising rates in March, but just muted at 25 basis points. Into Q2, things really took off from an inflation perspective. It ratcheted up massively to 8.5%, highest level since 1980. The Fed continued its hikes and pushed those levels up to 50 basis points, and then started to warn of higher rates. The market started believing this, and we saw the MSCI World Index come down dramatically in that quarter. Q3 was when the Fed really came out strongly against inflation, and that was at their annual conference in a place in the US called Jackson Hole, and Jay Powell came out very strongly and said, "Listen, we'll do whatever it takes effectively just to keep inflation down. We cannot afford this thing to get out of control." We had the US entering into a technical recession at that point for 2 quarters, but it's not an official recession. Dollar was strong, obviously on the back of higher interest rates, and it was decimating all other currencies. Euro was one of them. The fourth quarter was really, there was a lot of issues, obviously, but I mean, the big one was the political mayhem in the UK, debacle around their budget numbers that came out and what they wanted to do. The pound fell massively. Bond yields spiked up massively. And so, yeah, again, there was no real respite in the fourth quarter. Markets ended down in December. So, yeah, a very, very volatile year. So now we turn to predictions and the outlook. So I think the big thing on predictions, again, I put this quote up, and then I actually saw it quoted by a South African fund management company. But Yogi Berra, baseball playing philosopher, had this to say: "It's tough to make predictions, especially about the future." Yeah, a little saying, and there's so much truth in that. And just an anecdotal sort of point on that was something I came across in this rougher annual report, which is a global investment management house. And they said, okay, even if you had predicted that US rates would rise by 400, not the original 80 basis points that was forecast in January, or maybe you might have predicted that inflation would explode massively up to its 40-year highs. So you would have said, okay, well, we correctly predict that, so let's put a portfolio together of inflation hedges, your typical inflation hedge: gold, oil, inflation-linked bonds, and property. But it would have lost money. So again, there was no real place to hide in the year, and even if you got your predictions right. So I think the message really is we have to try and look ahead to navigate as best we can, but there's not necessarily a linear relationship between a correct prediction and then a correct specific investment. Overall, we want to try and get the overall investment strategy right, but we have to create a high degree, I think, of buffer in that. So if we move on to the sort of forecast, and what I want to juxtapose here is 2 points, or effectively 2 views. The first comes from BCA research. Now, this is official research that we get, and we've discussed their outlook with you, and I'll update the outlook. And they're a little bit more, I'll put there a bit more cautious outlook. So we've got a bit more of a cautious outlook from the BCA. And then I'm going to juxtapose that with a little bit more of an optimistic outlook from an outfit called Alpine Macro. They actually came originally out of this investment research house called BCA quite a few years back, five or so years back now. But they've got a little bit more of a positive outlook. First of all, BCA, yes, a recession is likely to occur into 2023. The big takeaway is maybe prices of risky asset stocks are expected to decline further because they're not yet pricing in this recession. I think everyone expects this recession to come. It's almost like the most widely anticipated recession, but they don't think risky assets as yet are properly pricing that recession in. Yes, the third point, the Fed is likely to cut rates down the line. Yes, the monetary policy is tight, which is going to contribute to the recession. And I think the next big point, and I've got just one chart on this, is the inflation story. Yes, inflation is likely to come down, but not necessarily quick enough to prevent a recession occurring. So their main takeaway at this point, it could change because they're constantly looking at an update, is that inflation is likely to slow down, but it's not going to go down massively. And I'll just juxtapose that with the Alpine. Other points they've got there, China, yes, expected to open up a bit due to the easing policies, but they're a little bit more cautious overall on China. They are continuing to cite the big macro issues there. We've seen the population numbers. There's a problem there. There's obviously this ongoing problem with the property bubble effectively that they've had and the over-leveraged situation there. A little bit more cautious on China. And so the ninth point there, just from a strategy perspective, and this is, we do concur a lot with this, is to take advantage of the fixed income rates, i.e. the higher yields, by overweighting a bit of duration. So take advantage of that. And from a equity perspective is to lean more towards defensive shares and companies as opposed to more cyclical. Well, that is in line with their more cautious approach. And we've seen markets run dramatically this year. So they could well, so far they're a little bit more on the wrong side. If we look at this inflation, as I say, this is just one chart I'm putting up, and they're basically saying, yes, obviously, the inflation is coming down. Effectively, the rate of change is coming down, but not necessarily quickly enough in order to avoid a recession. So that's their main big takeaway at this point. If I compare that to this more bullish outlook from Alpine Macro, as I say, this is not it's a totally separate outfit, but all of the main economists that came out of Alpine Macro came out of BCA. Anyway, this is their report that came through to me. It was right at the end of December, so even before we've had this big run-up. And their main takeaway is, yes, obviously we had an exceptionally volatile 22. They don't think the volatility will dissipate, point 2 there. The big theme will be disinflation and economic desynchronization. Disinflation is likely to occur quickly in 2023, this year, 23, possibly get to a point that's going to be too low, and they say for central bank comfort. So that's an interesting point because I don't think many economists or forecasters are looking at that. We'll have to see if that actually does play out. They a little bit more positive and bullish on China, thinking it's going to recover pretty quickly, back to at least 80% of its capacity, a lot more positive on China. And that obviously does play into some of the other points in terms of commodities and emerging markets. From a stock market, from a price perspective, they actually have made the view that with the market double bottoming in 2022, prices have effectively anticipated the the volatility, recession, etc. in this year, and actually expect it to rise. Yes, it will be volatile and risky, but they think the almost the worst is over at this point. So that's an interesting viewpoint and slightly different, obviously, from a little bit more of a cautious view coming out of BCA. Yes, earnings are likely to decline in 2023 again, but prices have already reached the lows. So prices are coming out. I don't think there's anything new in that. The earnings. There's nothing new in the fact that earnings are a little bit more muted and going to come off in 2023. They already have for the fourth quarter of last year started coming down. That's obviously as companies officially report through their earnings. It's exceptionally widely followed. Bonds, yeah, they're reasonably positive on bonds. And yeah, especially the high yield coming from emerging markets, and that's obviously South Africa, where we've got higher interest rates. A lot more positive on commodities and also on gold. Differs slightly from BCA. BCA is a little bit more muted on gold. They do keep a weighting, but they're not absolutely super positive about it. And yes, while they say economic desynchronization, effectively what that is really just obviously the geopolitics that's playing into the world. Economies, or affecting the economies, is making it a lot more difficult for companies to operate. Companies are having to look at different ways of their supply chain, moving things around. But as far as the investment outlook is concerned, as I say, a little bit more positive. Essentially, the view is that markets have already anticipated a lot. By coming off dramatically last year, they've anticipated a lot of what we're going to see this year. So that's an interesting take. And then just to juxtapose it with the BCA, I've put their chart up, two charts in their case, slightly different. The first one is just of the core inflation numbers. Obviously, it's coming down. The rental coming down and core goods coming down. So we know that. On the right hand side is the PCE, personal consumption expenditure inflation, and they're putting this up against their particular model, their model estimate, which is that red line. So their expectation, as I said, is that inflation is due to come down very, very quickly, much sharper than the market is anticipating, which will be supportive of obviously interest rates reaching a peak and possibly starting to turn. So those are two views, and our leaning is I won't say in the middle of the two. We definitely lean a little bit more towards the BCA. Fantastic if we do get this upside. We've already had so much of this upside as we stand here towards the end of January. Markets have ratcheted up dramatically and do appear to be looking through the problems. We've seen a lot of companies globally looking at laying off, big numbers. We've seen a volatility in prices, but we've at the same time seen the markets appears to be looking through and wanting to push up prices, and has been pushing up prices in anticipation of sort of inflation coming off and interest rates sort of peaking. But we will see. Is this just temporary and the pain is still needs to be felt? That's what BCA are saying, and that's why they're saying stay a little bit more on the defensive side. If we look at our global funds, we are a bit more defensively positioned, and we do from a local perspective, we will obviously be more exposed to the cyclical stocks, and so that's obviously benefited when China opens up and has opened up, and so we, in some respects, we sit in both camps, but it's not absolutely bullish at this stage. Some of the other big themes, and this is, I think, the big theme is the sort of end of globalization. I've put this quote up. This is the original founder of the big company, Taiwan Semiconductor Manufacturing, TSMC. They obviously operate out of Taiwan, opened up a big plant in the US, and he had this quote which was widely disseminated. Globalization is almost dead and free trade is almost dead. A lot of people still wish they would come back, but I don't think they will be back. So it's affecting companies. Companies have to change the way they do things. In many cases, it adds cost layers, changing things, that's for sure. But that's what companies do. They figure out how they need to operate more efficiently. You'll see a lot of macro sort of themes hit the news, hit the headlines. There's a lot of negativity in most headline news, but I think in many ways, I think some of the message I've heard and also want to pass through as well is that there's a lot of positive that will and can and does come out of this. An example is global labor shortages. At the same, companies are laying off a lot of people. Then they're also bemoaning labor shortages, but perhaps that's more investment into technology, and companies are putting a lot more investment into technology. It starts helping with their margins. So there's always a positive for a lot of the negative news headlines. I think we know that over the last decade, at least, there's been a huge amount of a huge lack of investment into energy infrastructure. That's got to change over the next decade or so. So the whole world is facing an energy crunch because of the lack of investment. That has to change. Climate change. There's a lot of investment going into a lot of different components. So it's not all doom and gloom. And if we look at the long run expectations on the next chart. So what I did is just updated. We've spent a bit of time looking at this last year, just the long run expectations versus the past. So there's the past 20 years in nominal terms. What did the main asset classes produce? And obviously, with prices having come down sharply in 2022, BCA have updated their next decade and said, okay, what is the expectation? Obviously, prices down, the expectation for returns is actually up. We all understand the maths, everything else being equal. So while it's more muted pretty much across all the asset classes, all these main asset classes, it's not going into reverse, it's not going negative. Does that mean that investors are going to have to pay a lot more attention to their investments? I do believe that is the case. Maybe in many ways be a lot more circumspect, especially where we starting off with the higher interest rates and obviously the high inflation. So US inflation over the last 20 years, 2%. Remember, everything gets priced off this. The expectation going forward is maybe 3%. And that's your minimum hurdle for all investors. We have to beat inflation. And so that's the big one. And so while they're saying we might not get the 9.2% coming out of US equities that we've had over the last 20 years, projected to come down to 5.7. Again, at least that's inflation beating. Emerging markets as well, 6%. So it's not all doom and gloom. In fact, there's a lot more upside as we stand now compared to clearly a year ago. So those are some of the expectations. And then I think just the last slide I wanted to put up is just firstly the one on the right, the chart on the right, the S&P 500, and then the index level. I mean, over time, ultimately, for an investor, your prices, i.e., your valuation, follows earnings. Earnings do go up. They do, from time to time, hit temporary setbacks. We're in that particular period now, as I say, already fourth quarter last year, they started coming down. The expectation is for them to come down here. I've seen some of the numbers come through with respect to margins. Margins are also coming down, but they're coming down from exceptionally high levels, record high levels in terms of margins that companies are producing. So there's no question that companies' earnings are coming down, but they have already started figuring out, okay, well, how do we start addressing this? Part of the reality is that we've seen a lot of layoffs this, or even the start of a lot of layoffs. And that will go some way to addressing that bit of margin contraction. Long term, prices follow earnings. Long term, earnings will go up. And so, in many ways, I wrote a bit of an article on this. We've got to focus on maybe the more of the knowns as opposed to the unknowns as investors. Patience is important. Discipline is important. Objectivity. Diversification, yeah, we spoke about diversification not always working. It didn't work too well last year, but we all do know it works over a long period of time. And risk management. I think these are some of the main points, and there are others, but I think if we can stick to these as investors and see through the volatile times, we will all be there, for the good times. So that's my message just on the global. We are a lot more positive and a lot more bullish this year. We don't want to be overly positive, but I think even when there's volatility, we have to maintain a high degree of being positive, and patience, I think, is the key. So without further ado, I'm going to hand you over to Tawanda. He's going to take you through just some of the thinking on the shortlist and some of the additions that we want to be making. Thanks, everyone. Tawanda.
Thanks, Ian, and good morning, everyone, on take two of this. I think I'm just going to give you a brief introduction of some of the changes that we've made to the shortlist. And this is a case of where we think more is better. And just with this new shortlist, we are adding more managers to the shortlist. We're adding more funds to the shortlist and helping you to construct better portfolios. So essentially, something that will assist you in those great characteristics for investors that Ian has just spoken about. So just to kick off on my first slide, this is just to give you some of the managers, of the new managers that we've got on the shortlist. We've added to what we had already, and maybe chopped off some managers that we didn't feel merited to be on the shortlist anymore. I guess, like I said, that this is a case of where we think more is better. There are a lot of good funds out there, and we understand the cyclicality of performances. Funds and managers tend to either outperform or underperform at different times. So we're just trying to go for a mix of different styles, different characteristics, so that at the end of the day, when you construct portfolios for your clients, then you get more stable performances over time. And just in terms of the diversity of the managers that we've selected here, as you can see, we've got a few boutique managers that we've added there. So the likes of a 361 on the flexible side, a My Plan on the income side, and a Truffle on the flexible side as well, and then portfolio metrics on the income side. We've always had quite a lot of large managers on the shortlist, and then the funds that have good long-term performances. As you can see, we've still got quite a few of those large managers on the shortlist. And then additionally, I know this is quite a big thing in the market, where investors are more cognizant of cost, and they're looking at managing costs when it comes to their investments. And we've added a few more managers on the low-cost side, so that we can help you to manage those costs when it comes to investing for your clients. And then we've got a Seed as the multi-manager there, so just giving you diversity to strategies, to funds with different characteristics. And then also on the offshore side, then we've added quite a few offshore managers there as well, just so that you've got a diversity of investment styles. So just to give you an example, we've got the Fundsmith there that is a quality manager, but then we would also be adding a Dodge and Cox that focuses more on the value side, so that you're not just always exposed to just one characteristic or one investing style. And then we've got the Old Mutual there that goes through different styles. So not necessarily a style specific, but would rotate through the different styles on the offshore side. If I move on to my next slide, just to give you a brief outline of some of the funds that we've got there. Like I said, as you can see, the key theme is more is better. So a wide variety of funds. Here I'm just giving you on the South African side, the multi-asset, income, low equity, medium equity, and high equity, just to give you a few examples of some of the funds that we've got on the short list. And then I've put an asterisk there on some of the new funds that we're adding to the short list. So if I just look at that conservative income category, then we've got on the credit side, we're putting in the BCI Income Plus, on a more multi-asset dynamic income fund. We've got a My Plan Enhanced Income Fund, and then also a little bit more aggressive fund on the income side, is represented by that Portfolio Matrix Dynamic Income Fund, which is labeled as the PMX Dynamic Income Fund. So essentially, just trying to put in funds that have different characteristics. Just on that income side, you can see BCI Income is a credit focused fund. Portfolio Matrix tends to be more duration focused. So just to give you a variety in terms of in terms of those funds, if you look on the local equity side, just a mixture of boutiques and large managers, but also just funds with different characteristics. Similarly, on the high equity side, just putting in your boutiques, your low cost funds, and your large managers. So a wide variety of funds that you have available for you to choose from on the shortlist. If we move on to the next to my next slide, then a similar thing. Just if we look on the offshore side and the local side, on a more aggressive or call it higher return capturing sort of funds. So we've added a new category there on the flexible side. So we've added the South African multi-asset flexible, which we think are a good block to build portfolios for clients. So there you can see the 361, Trafo, and Batalia coming in on the flexible side. And on the South African equity side, then I mean, we've always had the Fair Tree Equity Fund, and we've used the Coronation Top 20 Fund, or had it previously and historically on the shortlist. But then we've also added some low cost funds there, and then also a bit of a star agnostic fund in that 361 BCI equity fund. So more options for you to choose from, but also focusing on different styles. And then just on the global high equity and global equity, so more funds for you there. And like I've spoken to, just trying to add the different styles, just looking at quality, looking at value and low cost. So adding that element to the shortlist, just to give you more funds that you can use to build portfolios for your clients. If we move on to the next slide, then I'm not just throwing lots of funds for you that you don't necessarily know how you're going to use them. We are giving options on how to use these funds and blend them together to build portfolios for your clients. Historically, I've given you an example of a blend in the past. I just give you a suggestion and I give you a blend. But I do recognize that, or we do recognize that in the market, clients have different needs and you want to cater for different clients. So what we've done in the new shortlist is to give you different options of blends as well, not just go with one blend that might not necessarily be suitable for specific clients. So what I've looked at in this example that I'm giving you, if you look at the moderately aggressive, that multi-asset high equity category, I'm actually giving you three options of blends that you can look at. So just to go through the options that we've given there, if you look at the first option, so you will have a blend of high equity funds, but then these funds tend to be less volatile. So a defensive kind of high equity category. It still captures returns that you would expect from that multi-asset high equity category, but then the funds themselves tend to be less volatile. So you build a portfolio that tends to give your client a little bit more comfort. They can sit a little bit more easy in that high equity. it might not necessarily in all environments capture as much of the upside as some other options, but it does give you a high equity return with less volatility. So we've kind of called it a defensive, less volatile option in that high equity category. If you compare that to the second option that I've given there, which is which can be a much more volatile high equity blend, obviously trying to capture a lot more growth or a bigger return in comparison to that option. So it tends to be a little bit more volatile. And you can see the mix of funds there. I've even included a flexible fund in that 361 flexible fund that tries to capture a lot more upside. And I've got a low cost element in that net group core accelerated. So it's co-accelerated is a high equity fund, but that is just focusing on high growth. So you would probably expect to get a lot more volatility in that option too, but also trying to capture a higher return just from that option. And then the third option that I've given on the blend side, just going back to my point on clients being very cognizant of the cost, then we've tried to build a low cost blend. And in this blend, then you've obviously have a high allocation to the more systematic, to the low cost components, something like a net group core diversified and prescient balanced. You allocate a lot more to that so that at the end of it, you've got an overall blend that captures that low cost element, and you've got a low cost blend. So just to show you how we can actually build blends within the same category, but obviously different blends that give you slightly different things. And then just to round off on my last slide, so in addition to more funds, more managers, and more blends that we're giving you, we are assisting you in constructing portfolios. So giving you strategies that you can actually use to build portfolios or to construct solutions for your clients. And in this case, I've just given you two different strategies that you can use to construct a holistic portfolio for your clients. So in the first strategy that I've got there, which is a Regulation 28 compliant strategy, and then we'll obviously be using the blends to build this holistic strategy for your client. So as an example, then you can use and obviously and within the shortlist, we'll give you the specifics of the funds that you can use to construct these solutions. But you can pretty much build that Regulation 28 using a conservative or income blend, as an example, to allocate 30% to that income blend, and then allocate 40% to a suggested moderately aggressive or high equity blend. And then also to capture a little bit more of that upside on the local side, you can allocate to the SA equity and the flexible funds, allocating 15% to that. And then also offshore, in addition, because you've also got some offshore within that high equity and flexible categories, but then to obviously add a little bit more to that offshore, then you allocate to the global equity 15%. You remain with a Regulation 28 compliant, but a holistic strategy that you can use to build portfolios for a client. The strategy two that I've got there is to build a non-Regulation 28, and then obviously allocating a lot more to the global, to the offshore, and to the aggressive, and a little bit less on your income side and your high equity side. So just showing you that with these different blends that we're suggesting on the portfolios, we can actually use those to construct different portfolios for your clients. So really, really giving you options to construct portfolios that achieve those different client objectives that you may have. So actually assisting you in that journey with your clients so that you may achieve whatever investment goals that your clients have. We'll be sending out the shortlist within the next few days, so look out for it. If you've got any questions, if you've got anything that you need assistance with, then you can give Adrian, you can give Miguel and myself a shout, and we are always ready to assist you with that. And yeah, that's it from my side on the new shortlist.
Great, thanks, Tawanda. Okay, so just the last slide that we just wanted to just put in here is just some of these Reg 28 changes. Now, these came through last year and were announced last year, mid last year, and then come into effect 3rd of January. But we just put this big cautionary note up here. It's more for, I think it's more for information purposes really, because none of these changes will affect the CIS products. And so as a collective investment scheme, they need to comply, if there are Reg 28 funds, with the Reg 28 requirements, but they have the additional layer of the CIS regulatory overlay over that. And so most of these do not apply, but I'll go through them briefly. The first one is infrastructure. There's obviously this one particular one does apply, and that is the investments in totality are limited to 45%. And now they've come out with a definition saying, what is infrastructure? It's any asset class that entails physical assets constructed for the provision of social and economic utilities or benefit for the public. Okay, so that's fine. 45% is a high level. There's no concern there whatsoever. What they have done, pension funds, Reg 28 funds have been able to invest into hedge funds and private equity. Again, now this does not apply to CIS funds because CIS can't go and invest into private equity assets by and large, or hedge funds. They split the category now. Now it's 2 categories, additional 5% for private equity, so it's up to 15%, and 10% for hedge funds. They've mentioned crypto assets. As you may well know, there's crypto assets are coming in as a particular product from the financial services, but they, from a Reg 28 perspective, are prohibiting them. And then they put this cap of 25% in place. Again, should be no concern. Not more than 25% can be in any particular entity or company. And obviously then they've excluded government debt. So we can have 30% invested, or 35 or whatever, into government debt, but any particular entity or company up to 25%. Again, there's no concern with that one whatsoever. And this last one, not really actually relevant for any CIS, and that's really housing. Pension funds can grant loans to their members for housing. They've reduced the limit from 95% to 65%. Again, that particular one is absolutely not relevant for any CIS fund. So those are just some of the changes. It's really mostly just around the edges, so to speak. But if any clients of yours are asking, or if it pops up, at least you are aware of them. And then, I think the big thing, end of February, look at tax-free accounts, and obviously look at contributions into RA funds where any client is obviously short. These are things that you guys know, but that's just a reminder. So thank you, everyone. For many of you who were not on the on the live one, actually great if you can get this a whole lot better, because that was a debacle with the Microsoft issue. But I just want to say it's been a great start so far to the year, and we're looking forward to a fantastic rest of the year. And as Tawanda said there, any questions on any aspect of the portfolios, any aspect of the shortlist, any aspect of the funds, you know exactly where to contact us, and feel free. We absolutely are there to assist wherever we can. So awesome, guys. Thank you very much. Have a great day. Have a great rest of the week. Cheerio.